first market is the paper market. This is the world of futures contracts, ETFs, macro hedge funds, and rate-sensitive traders. These are educated, deeply analytical, but their time horizon is measured in weeks, sometimes days. They are not buying gold because they believe in its 1,000-year history as a store of value. They are buying it and selling it based on what the Federal Reserve is expected to do at its next meeting. When rate hike odds rise, these traders sell. When cut expectations grow, they buy. It is mechanical, it is fast, and it creates the kind of everyday investors nervous. The drop from $4,100 to $3,864 following the Fed's June 17th meeting was almost entirely a paper market event. Futures traders repositioning, ETF managers reducing exposure, hedge funds cutting their gold allocation in response to a more aggressive Fed posture. Jugan pointed out to CSC alert viewers that retail investors make the mistake of selling physical gold during these moments. They see the price drop. They assume something is fundamentally wrong. They follow the paper market's panic, without realizing that the paper market's panic has almost nothing to do with gold's actual long-term value. Because then there is the second market. And this one operates in a completely different dimension of time. The buyers here are not hedge fund managers watching a Fed press conference on a second monitor. They are central bank reserve managers, sovereign wealth funds, institutional allocators. Their job is not to trade a Fed meeting. Their job is to hold real, tangible assets that no government can freeze, debase, or digitally erase. The data that Jugan presented to the CSC alert community on this point was nothing short of World Gold Council. Global central banks purchased a net total of 244 tons of gold in just the first quarter of 2026 alone. Compare that to the 28 tons purchased in the fourth quarter of last year. That is not a gradual increase. That is an acceleration. A dramatic, deliberate, and very telling acceleration. And then there is China. The People's Bank of China has added gold to its reserves for 19 consecutive months without interruption. 19 months, through Fed meetings, through dollar surges, through rate hike scares, through geopolitical turbulence. Not once did they pause. Not once did they reverse course. Because their decision to accumulate gold has nothing to do with what happens at a single FOMC meeting in Washington. Jugan made a point that cut straight to the heart of the matter. When gold dropped to $3,164 on Wednesday, the central banks did not sell. When gold recovered and climbed back above $4,000, the central banks did not take profits. They simply continued doing what they have been doing for nearly 2 years, buying, quietly, consistently, without emotion and without hesitation. This is the foundation beneath gold's price that most market commentators completely overlook. Every time paper traders push prices down through aggressive selling, physical buyers are waiting at the bottom, not to flip a quick trade, but to absorb that supply permanently, to take it off the market, to move it from paper hands into vaults that will not be opened again for years. That structural dynamic creates something very powerful over time. It creates a floor that keeps getting higher with every passing quarter. Because the supply of physical gold being absorbed by central banks, sovereign funds, and long-term institutional buyers continues to outpace the selling pressure from short-term paper traders. And that imbalance only grows more significant as global uncertainty deepens. Silver tells a parallel story, but with an added dimension that makes its long-term case arguably even more compelling. Unlike gold, silver does not sit quietly in a vault. It works. It is consumed in solar panels, electric vehicles, semiconductors, medical equipment, and advanced electronics. Industrial demand for silver is not slowing down. If anything, the global energy transition is accelerating it. Jugan shared a number with the CSC alert audience that deserves very careful attention. The world is now heading into its 6th consecutive year of a structural deficit in silver. That means the amount of silver being consumed globally continues to exceed the amount being mined and recycled, year after year after year, 6 years in a row, and that gap is not closing, it is widening. When a commodity runs a structural deficit for 6 consecutive years, something eventually has to give. Either production increases dramatically, demand falls sharply, or prices rise significantly to rebalance the equation. And given the direction of global industrial policy, the energy transition, and the continued expansion of technology manufacturing, a sudden collapse in silver demand appears highly unlikely. Jugan closed this section of the analysis with a thought that CSC alert viewers were urged to sit with carefully. Paper markets create the noise, physical markets build the foundation, and every single week that central banks continue accumulating, every single year that silver runs a structural deficit, and every single time paper traders sell into the hands of long-term buyers, that foundation gets stronger, quieter, and far more difficult to shake. Every financial storm has a moment where one unexpected variable changes everything, where the carefully constructed models, the rate projections, the inflation data, all of it gets suddenly overshadowed by something raw, unpredictable, and deeply human. That moment arrived quietly, from a stretch of water thousands of miles away from Wall Street, and its implications were only beginning to be understood. Jugan directed the CSC alert audience's attention away from the Federal Reserve for just a moment, away from the PCE numbers, away from the dollar index, because something had happened in the physical world that was about to collide with everything the financial world had been carefully calculating. A drone had struck a shipping vessel connected to Iranian interests, and that single event was now sending tremors through global energy markets. Oil prices moved immediately. Crude climbed to $71.35, up $2.09 on the day. That kind of move in oil is not background noise. It is a signal. Because oil does not rise in isolation, when oil rises, transportation costs rise, manufacturing costs rise, food prices rise. Every layer of the economy that depends on energy, which is every layer, begins to feel the pressure. And that pressure has a name: inflation. Here is where the situation becomes particularly complicated for gold and silver investors. Under normal circumstances, rising inflation is positive for precious metals. It erodes the purchasing power of paper currency and drives investors toward hard assets. But this specific scenario carries a dangerous twist, because the inflation being generated by rising oil prices gives the Federal Reserve even more justification to raise interest rates. And rate hikes, as already established, create headwinds for gold and silver in the short term. Jugan walked the CSC alert community through this carefully. The drone attack on the shipping vessel was not just an isolated geopolitical event. It was a potential catalyst for a chain reaction. If the Strait of Hormuz, one of the most strategically critical waterways on the planet, becomes too dangerous for commercial shipping, the consequences extend far beyond oil prices. Global supply chains tighten. Insurance costs for maritime shipping explode, and energy markets enter a state of sustained uncertainty that no central bank has a clean policy tool to address. The scenario Jugan outlined for CSC alert viewers was direct and unfiltered. If ships become too nervous to pass through the strait, if the waterway effectively shuts down even partially, oil will not stay at $71. It will move significantly higher. And when oil moves significantly higher in an environment where inflation is already running at 4.1%, the Fed's already aggressive posture becomes even more hawkish. Rate hike odds that currently sit at 68% for September could climb even further. And that additional pressure could push gold well below $4,000 and silver closer to the lower end of its yearly range. Jugan did not present this as a certainty. He presented it as a serious possibility that every CSC alert viewer needed to hold in their awareness, because the market that was celebrating a modest gold and silver recovery on this particular day had not yet fully priced in the Iranian variable. That repricing, if it came, would likely arrive with Friday's trading session, and it would not be gentle. The potential downside numbers were sobering. Gold could fall to $3,800, possibly $3,700 under a worst-case scenario where oil shock compounds rate hike expectations simultaneously. Silver, which had been pushing toward $60 with quiet confidence, could find itself pulled back sharply toward the lower targets that careful analysts had identified as the year's potential floor. These were not predictions. They were calculated possibilities, and serious investors do not ignore calculated possibilities. But here's where Jugan brought the CSC alert audience back to the most important perspective of all. Because beneath all of this short-term turbulence, beneath the drone attacks, the Fed meetings, the oil price spikes, and the dollar surges, the long-term structural story for gold and silver had not changed by a single word. Not one chapter of that story had been rewritten by anything that happened this week. Central banks were still buying. China's People's Bank was still accumulating for the 19th consecutive month. Silver was still running its 6th straight year of structural deficit. Physical buyers were still absorbing every wave of paper market selling with calm, deliberate patience. The foundation that had been built beneath precious metals over years of sustained institutional demand was not shaken by one Fed meeting or one drone strike. Jugan reminded the CSC alert community of something that is easy to forget during volatile weeks like this one. Physical gold and silver are not day trades. They are not positions to be entered on Monday and exited on Friday based on whatever headline crosses the wire. They are long-term allocations, slow movers, assets that are held through cycles, not managed within them. And that distinction is not a minor philosophical point. It is the entire strategy. When purchasing power erodes slowly and steadily, as it has been doing for years, physical gold does not need a perfect macroeconomic environment to serve its purpose. It simply needs time and patience, and the discipline to hold while paper markets create the kind of noise that shakes out investors who never fully understood why they owned it in the first place. Jugan closed the analysis with a final thought directed specifically at the CSC alert community. The week that just passed was not a reason to panic. It was not a reason to sell. It was, in fact, precisely the kind of week that reveals the difference between investors who truly understand precious metals and those who are simply along for the ride until things get uncomfortable. The Fed's threat is real, the Iran risk is real, the rate hike pressure is real, but so is the 244 tons of gold that central banks purchased in a single quarter. So is China's 19 months of uninterrupted accumulation. So is silver's 6-year structural deficit. And when all of those realities are placed on the same scale, the long-term direction of gold and silver becomes very difficult to argue against.